We have this incredibly bloated financial sector. It's a phony crisis. They don't have to be cuts. We know how to get out of a Great Depression. You spend money. If we take a look at the typical worker, they're not doing fine.
Hi, I'm Dean Baker, your host for Mostly Economics. Today on our recording, we have with us Jacob Faber, who's a professor of sociology and public service at New York University, also a co-founder of the Redlining Lab. He's one of the country's leading experts on discrimination, racial discrimination, housing, and other areas. And today what we want to talk about is the history of discrimination in housing and finance more generally. So Jacob, welcome to Mostly Economics.
Thank you. One quick note, it's Faber, not Farber. But
I'm sorry.
That's all right.
Somehow in my notes, it's more than once in my life I've done a typo and I somehow added the R. So I'm very sorry about that.
Yeah, totally. Yeah, very fun. Yeah.
Jacob Faber, I'm sorry. Okay. Thank you for correcting that. So
yes, happy to be here. Yeah.
Okay, so I thought a good place to start, we both lived through the housing bubble, but I realized for a lot of people that might seem like ancient history. So I think it might be good to talk about, we know that Blacks, other minorities were disproportionately hit by the collapse of the bubble, higher default rates, foreclosure rates, of course. So maybe if I could say a little bit about, what it was, the discriminatory practices that led to a situation where so many minorities ended up losing their homes in the collapse.
Yeah, and this is kind of where I actually started my academic career. I started my PhD in 2010, at the nadir of the foreclosure crisis, and with the intention of kind of studying the causes and consequences of this, once in a century economic downturn, because like you, I was really quite struck by the dramatic inequalities in subprime lending that led to the crisis, and then the resultant foreclosures. And one statistic that is really stuck with me all this time is something that I've found researching the kind of intersection of race and class at the peak of the subprime lending boom. So in 2006, Black and Latino borrowers making around $250,000 a year were more likely to get subprime loans than white borrowers making $35,000 a year.
That's incredible.
So the inequalities were incredibly drastic and were widest actually among the wealthiest borrowers. And because we live in a still quite segregated country, the fallout in the form of foreclosures, but also, of course, unemployment, declining housing values, all of the kind of add-on consequences of the recession were also concentrated in Black and Latino communities.
Yeah, it's one of the things, and again, this we lived through it, but I mean, for a lot of people, this is history, or they didn't follow closely, or they were younger then. But I mean, it was striking that you had so many cases. I mean, you had not just that you had people who were buying homes that were given subprime, worse mortgages because they were Black. But there were real efforts, of course, you had people already own their homes, and there are any number of stories where they got people to refinance with subprime loans. They owned their home, and it was just, and this was, again, I don't have the data on that, but I'm sure that was disproportionately in minority communities.
Absolutely. And this is a very common misconception about the subprime lending boom. One of the prevalent narratives during the period was that, these undeserving people were buying homes that they couldn't afford. But as you said, and this is reflected in the data, approximately 80% of subprime loans were refinance loans. So these, again, were people who already owned their home, already had a mortgage on their home, and were in many places approached by predatory mortgage lenders, with these fanciful teaser rates and ballooning payments on their mortgages, basically misleading both lenders and borrowers. And we know this again through the data. The data kind of show this systematic targeting of communities of color, but we also know it from whistleblower reports from within lending institutions that has been widely reported, that these neighborhoods and these individuals were targeted because there was profit to be had in the exploitation of these neighborhoods, and because of a rather dramatic shift in mortgage lending, where I would sell you a loan, or make a loan to you, and then I would sell your mortgage kind of up the chain. The kind of incentive to me that you stay in your home and make your payments kind of went away. So I have no financial interest in you being able to afford the mortgage that I sold you.
Yeah, it really was an incredible time. And it was one of these things that, I mean, it's not that I was particularly prescient. I was alive and breathing, but I was writing about this at the time. And it was just amazing that you had so many people in positions of responsibility. I'm thinking first and foremost, of course, of the regulators, but, other economists. And they were just dismissing that there was any issue there. And you could see that they were issuing massive number of loans. And as you mentioned, the ones with teaser rates. So the classic, I think this was most of them. These were subprime. So almost all of them were subprime. So maybe all of them. The 228s, where you had a lower rate for 2 years, and then it would jump often by 4 or 5 percentage points to a market rate. So you'd start with a lower rate that you can go, I could afford that. And then, it would jump after 2 years to something you couldn't afford. And it was about the most predictable thing in the world. A lot of people would suddenly find themselves in difficulty. And again, ordinarily, the old story of the bank, well, they'd go over you with a fine-tooth comb because they want you to pay off the loan. But when you sold it down the line, you didn't care. And,
Right.
that was all the way down the line because you sold it to an investment bank, and the investment bank was going to repackage it. It was going to package it into a mortgage-backed security, and they would sell chunks of that all over the world. And they
Exactly.
got... I'm sorry, I'm going on here. I should let you
No,
jump in. I'm just getting carried
that's
away.
fine. Yeah. No. Yeah.
Anyhow, you had everyone just nodding their heads and go, "This is fine." And with and there were reports at the time. I mean, none of this is hindsight because it was, it became a joke in the industry. They talked about, there was a line, ninja loans, no income, no jobs, no assets, because they didn't care. I mean, obviously most of the people did have assets, they did have jobs, but the point was they didn't care. They didn't care because they could sell anything. And then the investment banks would repackage them, as I was saying, and they'd have mortgage-backed securities. And then the rating agencies, Moody's and Standard & Poor's and Fitch, they would all give them investment grade ratings or mortgage-backed securities because they wanted to get hired to rate the next one. So
Right.
you just had it was corrupt from top to bottom. And again, it was all visible at the time. So it's not like, people go, oh, you can see that in hindsight. No, and again, I wasn't the only one saying this. I mean, there were other people saying it, but, you had, as I say, economists that, were looking at it, some of them experts in the housing market, some just macroeconomists, but this was a huge macro phenomena, just looking the other way. And then, the regulatory agencies, first and foremost, the Fed, they were asleep at the wheel. I'll never forget, Alan Greenspan was chair of the Fed at that time. I think he left in January of 2006, if I'm remembering correctly, but that was, after the bubble, well, just about as the bubble had peaked. And he recounted, because this was after the fact, the story in the Wall Street, Washington Post had, they were talking about the collapse, the bubble and the collapse. And Greenspan said that he had seen some report saying that 26% of mortgages issued in 2005 were subprime. And to give people background, the normal was around 8%. So that really was a massive increase. And again, this is what Greenspan told the reporter. He said he couldn't remember whether he passed this information on to Bernanke, who was his successor. And it was just sort of like, this wasn't secret information.
Right.
This was,
Right.
Anyhow, I'm sorry, I'm running off here, and
No, it truly was in retrospect, a very curious time. I mean, there was a tremendous amount of, I don't know what to call it, magical thinking. People with their head in the sand, the idea that the housing market always goes up, it's always the best investment, and again, in retrospect, it all seems odd. It's the maybe cleanest way of saying what happened.
Yeah, I remember, the immediate aftermath, there were these big efforts to blame the Community Reinvestment Act. And,
Right.
Again, that made just basically zero sense. I'm sure you've done much more work with the Community Reinvestment Act than I did, but it was a pretty hard story to tell.
Right. And, the Community Reinvestment Act, basically, requires that banks invest in the communities from which they take deposits. But in, political parlance, it's, a dog whistle kind of coded as serving Black and brown communities, again, who were kind of portrayed as undeserving, and buying these homes that they couldn't afford.
Yeah, and of course, the striking things was the worst loans weren't even made by institutions covered by the Community Reinvestment Act. The worst loans were made by mortgage banking, what they call a mortgage, I can't think of the right term for it, mortgage banking issuers. There's a term I'm forgetting here, but anyhow, they weren't banks. They'd raised money on Wall Street, and they weren't covered by the Community Reinvestment Act because this applied to depository institutions. So that applied to your bank where you have your checking account, your saving account. They had to make loans under the act to within their community, and It was always very weakly enforced in any case. But
yes. Yeah.
But the worst issuers, were not even covered by it. So it was, it just literally made no sense.
Yeah.
And go ahead.
I was more just sighing than looking to jump in.
Yeah. So anyhow, I mean, it was again. I think anyone who looks at the data, I think it's very unambiguous that the bubble and the collapse was caused by banks and other financial institutions looking for quick money. And for a while they were getting it. I mean, you could go back and read the reports and, 04, 05, 06, they, were making profits hand over fist. But, then when it collapsed, of course, they then needed bailouts. But again, the insofar as there was an effort to increase lending to minority communities, that was mostly cover. I mean, they were happy to make money on anyone, but it wasn't, their motivation was making money, and the fact that the loan, yeah,
and these and as we mentioned earlier, these predatory loans that they could resell, became a volume game rather than a quality game. And one of the, I know you wanted to talk about this at some point, but the kind of direct connection between the kind of geography and racial inequality in subprime lending is tied, directly to historical patterns of lending discrimination and exclusion, which is, why a number of scholars kind of refer to subprime lending, the subprime lending period, as reverse redlining or predatory inclusion. These, basically you had these neighborhoods that were ignored, discriminated against by commercial prime lenders for generations, which created this market void in which subprime lenders could really thrive.
Yeah, no, and I think it's a good way to put it, reverse redlining, because that is very much what happened. That they picked out areas that they saw as ripe for the picking, and again, so many of the stories. I mean, so many of them are just horrible. It's hard to decide what's worse, but I remember hearing stories of. I don't know if Detroit was particularly singled out for. You have a large Black community, of course, in Detroit. And yet a lot of Black people, as I say, they literally owned their home. They paid off a mortgage.
Yeah.
And
Yeah.
they had people come by and, tell them, oh, I'll give you this great, you could refinance, you could take money out to, give to your kids or grandchildren or whatever. And, and then people would end up losing their home. It's
Right.
just,
Right.
Yeah.
And in the wake of that, now we have this booming private equity purchase of these homes in the very same neighborhoods.
Yeah. No, it is discouraging. Yeah, you made reference, and we might as well get into it, that the issue of redlining and the legal, the legal and formal basis for that. Because again, it's one of these things. I'm old enough. I'm 67. I'm old enough to remember. It was during my lifetime that it was literally legal to refuse to sell to someone because they're a Black person, and this wasn't just the South thing. So, a lot of us, I put myself in that category. I have this idea, the backward South, and, Alabama and these other states. But it was the North. I grew up in Chicago, and it was, it was totally legal, for a bank just to say, I'm not going to make a loan to you, at least not in this area, if you're a Black person.
Right. And, the story of discrimination in housing is as old as the United States, but a real inflection point was the New Deal, as massive government response to the Great Depression, and most people think of the New Deal as a jobs program, and it certainly was that, but it was also designed to address what was an unprecedented collapse of the housing market at the time, and there were these enormous federal programs, most notably the Homeowners Loan Corporation, which was a kind of foreclosure prevention program, and then the Federal Housing Administration, and then somewhat later the Veterans Administration loan insurance programs, which were part employment programs, to get people building homes, but also programs to encourage people to become homeowners. And what these programs did was they kind of institutionalized and made widely available the long-term fixed payment mortgage. And it's hard to imagine today in 2025, but 100 years ago, that particular critically important financial instrument didn't really exist in the United States. Many mortgages were these short-term loans, 3 to 5 years. They weren't amortizing. People rolled them over largely at the bank's discretion, so that they were more akin to payday loans than what we would consider a mortgage.
Yeah.
And so the federal government, in partnership with private lenders, set up this market changing relationship of federal insurance for these mortgages. And over the course of the middle of the 20th century, the homeownership rate in the United States went from around 40% to around 2/3, because buying a home became cheaper than renting for most, not most, but for many people in the United States. And it also became, because it was this amortizing financial instrument, it became a way to accumulate wealth and pass it down. So with this massive intervention, again, we kind of create the American Homeownership Society, but these programs were designed in racist and segregationist terms. So they explicitly discriminated against people in neighborhoods of color, which were almost exclusively Black neighborhoods at the time. And so this was this was completely legal. completely legal. And not only was there the way that you described it, the kind of active discrimination of a mortgage lender, right? But the Federal Housing Administration, is responsible for creating many of the kind of suburban communities that we now see as completely normal, but required that developers, attach these racially restrictive covenants to properties that they were insuring. So blacks, Jews, other undesirable immigrant groups couldn't buy in many of these communities. And the term, this is all a very long way of answering your original question, which was about redlining. So the term redlining refers to the kind of explicit discrimination of more in mortgage lending against communities of color.
Yeah, that was. I'm trying to think. There was a very good book, When Affirmative Action Was White, and I'm spacing on the name of the author, who I actually know.
Ira Katz-Nelson. Yeah.
Yes.
Yeah.
So, and it recounts kind of this history, and it's kind of a remarkable story because, in a sense, it's a great policy. This was stemming from the New Deal, and then following World War II, you had the GI Bill of Rights, which gave people low-cost mortgages. So this really helped build a middle class, but it was overwhelmingly a white middle class.
Yeah.
So it was, and obviously as male, because, it was mostly men who were in the military. So you make it veterans benefit. That mostly went to men. There were some women, obviously, but disproportionately that was a male story. So it was great policy, but it was white males that it benefited, and blacks, and they were less prominent. We had fewer Hispanics at the time, so that's what I'm saying, less prominent.
Right.
But they were largely left behind. And again, it was almost by design. Well, some of it probably, I'm sure, was by design, but it was just like, where you're designing a good policy for home ownership, but if blacks can't, they're excluded from owning homes in many areas, then obviously, that it's going to very much limit the extent to which they could benefit from it.
Right. And this because basically, if we decided as a society, the federal government decided that home ownership was going to become the most important tool for asset accumulation and intergenerational economic mobility, it set the groundwork for the racial wealth gap that we have today, that is wider than when I was born in 1981.
And it's again, it was, you could decide how much that was deliberate. And again, in some cases it was absolutely deliberate, but in many cases it was just okay, we're designing policy to help veterans, and you sort of look the other way, that this is mostly policy helping white veterans. There are obviously plenty of black veterans who weren't in a position to benefit. And then again, I'm trying to remember, the Fair Housing Act was 65.
I always get these. So 67 is in my head, but around that.
No, you might well be right. I know it's somewhere in the mid 60s. My point, trying to get the date, was just saying until that point, it was actually totally legal. So, and it's not by passing the act we stopped all discrimination. There was a great article by economist William Darity, who's at Duke, where he looked at want ads. This is, for hiring, want ads in newspapers before the Civil Rights Act was passed in 64. And they were openly, they say, we want someone of European descent, and they also sexist too, we want a woman, we want a man, and so that's what they were advertising, that presumably reflected what they wanted. So then you pass the Civil Rights Act, so it's illegal to discriminate. Well, do we think they stopped discriminating?
Right.
So again, we passed the Fair Housing Act, and that made it ostensibly illegal, but that doesn't mean that you didn't have plenty of banks and realtors who were still very much, we're not going to sell to a black person. Again, at least it was illegal, but it's not as though most of them would have the good sense not to say, oh yeah, that's the reason we're not we're not selling to you. But, it's, and in principle, if you could prove that they're discriminating, you could win a suit, but that's a hard thing to do. And
Yeah, it's almost impossible. This is, and you're right. So we had this, there is a suite of federal, so there's the Fair Housing Act, there was Community Reinvestment Act, the Homeownership Disclosure Act. There was a whole bunch of these policies that made explicit discrimination legal, but which is, was a great victory, but severely limited. One in what you just said, which is that they still generally require the victim of discrimination to prove intentional discrimination against them, which is almost impossible. And it did very little to address more covert or implicit forms of discrimination. So we know that the phenomenon of, what's generally referred to as steering is still quite widespread. So, real estate agents will steer white borrowers or white home seekers towards white neighborhoods and black home seekers towards black neighborhoods, often in not so subtly racist coded language. And that's still kind of a widespread phenomenon. There was a great expose a few years ago done by Newsday on Long Island, where they did a kind of hidden camera audit experiment where they sent testers to various real estate agents and unsurprisingly discovered quite widespread discrimination against people of color. And of course, these policies didn't do anything to address the underlying inequality that was created through centuries of racially unequal wealth accumulation.
Yeah, no, that's one of the things that it's very hard to overcome. I mean, I know when I first bought a place with my wife, both of us have PhDs in economics. I'm just saying that because we're obviously better situated in the scheme of things than most people. Just have two very educated people. We don't have kids, so we're in a better situation to buy a home. We still got help from our parents. I mean, we could have done it. We might have had to wait a little longer. I mean, so it's not as though that was the only possible way, but getting help from your parents and making a down payment, it's very typical for someone from middle-class background, but that means that your parents have some wealth, and
right.
If your parents don't own a home, they haven't been accumulating a lot of money in, a 401k or whatever, they're not in position to help out their kids. So, that's just a reality. And again, it's not, and it is heavily race-based because, again, we have the data on that. Was it homeownership rate among blacks is about 45%, somewhere around there?
Yeah, that's about right. And it's about where it was when the Fair Housing Act was passed. It's barely budged.
That's just incredible. So it did go up in the bubble years, but that proved not to be a good thing. I mean, if you had a home with a subprime mortgage, that was basically set for you to fail. That was not a good thing. Yeah. So anyhow. So it's one of these things, again, we had good legislation that made progress, in the 60s primarily. I guess Community Reinvestment Act, was that still the 60s or was that the 70s that was passed?
I honestly, I don't remember.
Anyhow, it doesn't matter. My point just being, we could point to these and clearly they were steps in the right direction, but they didn't go very far. And then, well, I don't even know what to say. I did want to talk somewhat. I'm always hesitant to say this now. I did want to talk somewhat about the current policies, but they really are, in many ways so over the top. And half of it, I always say it's probably best not try to get in Donald Trump's head. But, some of his executive orders don't just roll back what we might think of as affirmative action, whatever the hell you want to call it, policies of, say, the Obama and Biden administration. Some of the executive orders, at least as written, would roll back policies from the 60s. So,
well, and this is not my phrase, but they are some are. I think it's reasonable to accuse them of trying to repeal the 20th century. They're going after birthright citizenship, but to try to stay focused on housing, the Trump family's, historical wealth was made via racist housing provision. His father was sued by NAACP for discrimination. And we know about his practices as a business owner. And it's really quite distressing to see how certainly they are rolling back the moderate kind of anti-discrimination policies of more recent administrations, but they're going further than that. They are weaponizing certain aspects of anti-discrimination policy to argue that efforts towards diversity, equity, and inclusion, right, are discriminatory against white Americans. The attacks on affirmative action, it's the same thing. Again, trying to stay focused on housing, but and financial services, but they're trying to destroy the community Consumer Financial Protection Board, and who knows what's going to happen with the Home Mortgage Disclosure Act data, which is a data set that I use quite often and a lot of scholars use, which basically requires all mortgage lenders to report their activities to the federal government. And it's one of the major tools that researchers and community organizations used to identify subprime loans as well. So it's dark. It's really dark.
There's an important point on that I think people don't directly work with the data or involved in pursuing discrimination cases may not be aware of, because there's we were talking before how difficult it's to prove discrimination. So it's very rare these days that you'll have a bank or a realtor say, well, I'm not going to sell you that house, I'm not going to give you the loan because you're black.
Right.
They're not going to say that. It's very rare you'll get someone who say that. So how do you prove they discriminate? Well, you have to show a pattern of behavior, and that requires having the data. So that's, this is the data set you're referring to, other data sets. I mean, you have to collect a lot of data and show, okay, you had, 1,000 people apply to you for loans. Here are the black people applied. Here are the white people. You overlap the, 5 years, 10 years job experience. You have and you show, well, blacks were less likely to get a loan, even when they had comparable earnings history, comparable assets. So you need the data. And if you don't have the data, you don't have a case.
Right.
And, and that's what they're trying to do. They're trying to take away the data. And, again, there's so many times where, again, no one's going to get up there and say, oh, we discriminate, so there's so many times though, when you find the data, when you're mentioning a moment ago, I was thinking about it, and I'm sure you've seen these studies where they looked at what's the term? Appraisers.
Yeah.
And, well, you could talk about it. I'm sure you know more about it than I do, but it's amazing stories.
Right. I mean, so there was a kind of mushrooming or an explosion of these stories, maybe 3 or 4 or 5 years ago, of basically, black homeowner tries to is going to sell their house, so they get it appraised. It's lower than they think is appropriate, so they get their white friends or relatives to pose as the owners of their home and get it appraised again, and it gets appraised at a much higher value when there's when it's presumed that white people own the home. And there's great research by by Junia Howell and Elizabeth Corver Glenn, two other sociologists in the housing space, have shown that this is certainly more common than the handful of stories that make it to the New York Times or what have you. This is a systematic bias that is, part individual bias, certainly on behalf of the appraisers, but also kind of ties back to these New Deal era policies and the practices of redlining, which kind of intentionally conflated the presence of Black people in a neighborhood with lending risk and declining home values. That again, it kind of can't be kind of reiterated enough that these were intentional decisions that were made that encouraged segregation and created financial incentives for racial segregation. We're kind of still living with the fallout of these policies that are now almost a century old.
My wife and I had some sort of firsthand experience with it. There wasn't really much consequence, but we wanted to refinance our home. I think it was 2010 thereabout. There'd been a big fall in interest rates. So I thought, I'll get a better deal on a mortgage. So we wanted to refinance our home, and we arranged to have appraisal. And we had put down a large down payment at that point. It was the second home we had, and we wouldn't have been close. In other words, so it wasn't like a 90% loan to value or anything. It wouldn't have been close. So anyhow, we had an appraiser come out, and he gave us an appraisal that was way below what houses were selling for in our neighborhood. And we thought it was really strange. And my wife realized that we lived in a largely Black area, and one of our neighbors was out as Black doing yard work. And we thought the guy, the appraiser saw him and figured, it's a Black area. Anyhow, so we didn't get the mortgage. And, the part, kind of the confirming part, the mortgage rates then jumped up again. It just, I didn't have any great insight. I could see what the mortgage rate is, but I didn't know where it was going. But they jumped up, so we're going, damn it, we lost a chance. Then they fell again, 6 months later. So we go, okay, we'll try again. And we then put in for the mortgage. They sent our appraiser out. He gave us an appraisal that was 75% higher.
Oh my gosh.
And we hadn't done a thing to the home. It wasn't we put in an addition. We hadn't repainted it. We had not done a thing. So, again, it was, there's always some arbitrariness, and two appraisers will give you the exact same appraisal. But, this was, it was just clear.
Difference.
Yeah. So, so my assumption, my wife's assumption, I wasn't there at the time, that, that he saw our Black neighbors and said, okay, this home, it's a Black neighborhood and just not worth that much. So it's kind of incredible. So I'll just briefly, I want to, because we're taking a lot of time, I don't want to take too much of your time, but you mentioned the rolling back of or gutting the Consumer Financial Protection Bureau, and I guess we still don't know where that's going to be going. I mean, they've I don't even know if they're doing any enforcement right now, but it really, I mean, to my view, it was a great step forward, and I think underappreciated. Well, maybe I shouldn't say underappreciated, because I think the people benefit appreciate it. But the other side, I remember Elon Musk, before Trump won and before Doge, he once tweeted delete for the Consumer Financial Protection Bureau.
Right.
But it really cracked down on a lot of abuses, and again, these disproportionately targeted people of color, Blacks and other people of color. And I'm thinking here of payday loans, just trying to limit the abuses. And again, there's, because I've been back and forth, I'm sure you have as well, on the issue, it's not necessarily a bad thing for people to have access to easy credit like that. The problem is the interest rates, and basically how it's structured so that people won't be able to repay it. And
right.
Anyway,
And
go ahead.
And no. I mean, I became interested in studying, what, or you can think of an umbrella term as alternative financial services or fringe financial services. Like, so you mentioned payday lenders, but also check cashers, rent-to-own stores, pawnbrokers, tax refund anticipation loans like H&R Block, as part of a larger ecosystem of financial service discrimination in which mortgage lending discrimination resides as well, because it's the same neighborhoods that where subprime lending and foreclosures were concentrated, are the places where these often predatory financial institutions are located, and they tend to charge quite a bit more kind of per transaction than your typical bank. And there's a kind of large and growing body of research showing the enormous disparities in exposure to these types of services. So if you live in a Black or Latinx neighborhood, you're far, far, far more likely to have one of these alternative financial services, a payday lender or a check casher, nearby than if you live in a white neighborhood. And if you live in a white neighborhood, you're far more likely to have a commercial bank in that neighborhood. And I think today in 2025, where so much of our financial life is occurring online, via apps in our phones. There's a lot of people who question whether or not the geography of these institutions matter, but they really do. Especially for people who are facing, what an economist might call the kind of liquidity constraint, right? Somebody who's kind of cash poor and gets a paycheck and needs to pay a bill. A check casher is an attractive option, even though you're kind of losing a few percentage points off of whatever your paycheck is. And these fees can really accumulate over the course of a career, of a lifetime. There was a paper. I haven't seen any more recent estimates of this, but there was a paper from 2008 by the Brookings Institution that estimated that somebody who is using a check casher over the course of a lifetime would lose around $50,000, which is quite a bit of money, especially to lower income individuals. And especially if you think about, if you have a counterfactual in which you're investing that $50,000 in an index fund, then we're talking about hundreds of thousands of dollars. And so this is, not only critical in kind of shaping inequalities in kind of household asset accumulation, but again, from a neighborhood perspective, this is kind of limiting the wealth within a community, and kind of creates this kind of self-reinforcing cycle, where certain neighborhoods are kind of targeted for more expensive, more predatory financial services.
Yeah, I'm forgetting what the numbers. I used to know this stuff better, but I think we have roughly 10% of the population's unbanked, and then for Black, I know it's much higher for Blacks. Was it 20 or something? Would you have those numbers offhand? I
haven't looked at them recently, but that sounds about right. I know the unbanked rate has been declining slowly, and it's tricky because it's an obvious solution that many policymakers kind of jump to is, well, we just need to get people bank accounts. And of course, bank accounts can be useful. Probably everybody should have one. If you're going to participate in today's economy, you pretty much need one. However, research that I've done in partnership with Terry Friedline, who's at University of Michigan, have shown that even commercial banks in communities of color tend to be far more expensive than those in white communities. So there are larger, minimum balance requirements. There are larger fees that are more punishing for things like overdraft or kind of falling below the minimum balance. So it's, there are practices that kind of commercial or traditional banks kind of have that are arguably predatory. And one of the aspects of these policies that is, I think, underappreciated is the kind of devious way in which these policies are often kind of hidden from consumers. So if you, when there are polls of people who, don't have bank accounts, far and away the largest reason that somebody doesn't have a bank account is financial. So I don't have enough money to keep a minimum balance for a bank account. But often this varies a little bit year to year, but typically the second or third most common response for not having a bank account is kind of lack of trust. And if you ever tried to read the agreement that you have to sign to open a bank account, it's impossible. And contrast that with a check casher. You walk into a check casher and everything is completely transparent. The menus look like a fast food restaurant's menu. Everything is very easily digestible. There's nothing hidden. And so it can be kind of perceived as less expensive.
Yeah, no, there definitely is, there's an issue there with the, very big issue with the complexity. I remember, I'm telling you again about my own experiences, but it was informative, at least to me. When we got our house, some years ago, I guess in 2009, I arranged to have direct deposit of my mortgage, anyhow, and not worth going into all that, but I got this note that we're going to move to foreclose. I go, what? And so of course call them up. I want to lose my house. So I call them up. I go, what? You have direct deposit. There's money in the account. And anyhow, I apparently had missed their first date for it, so I had to have it, in by whatever the 20th. I got in the 21st, and even though they had permission to take the money out of the account, by their policy, if they're already 1 month behind, they don't do that. So they had me 2 months late. So they had some big fine. And, so anyhow, we argued back and forth. I did end up paying some penalty, but much, much smaller one, because you had access to the money. I don't know your policy, but again, I'm someone with a PhD in economics. I'm just saying I'm more used to dealing with these things. I could deal with forms. I know the law to some extent. Whereas someone who's less educated, less used to, they'd be stuck with this crazy fee. I can't remember what it was, several $100s, and I'm like, you had my money. I shouldn't have to pay you anything.
Right.
So anyhow, I don't blame anyone for being concerned that they can't figure this out, and because it's again, I couldn't figure it out, and anyhow. So I've been with you for a while. There are other issues you want to raise? I don't want to, I want to keep you here all day, but are there other issues that you want to raise before we let you go?
I mean, one thing that, again, I'll reiterate, that's or rather two things that I think are the most important for folks to keep in mind are, again, that the inequalities that we see were intentionally constructed, through public policy, and so there's, you can kind of good news spin this if you're so inclined, in that, because we know what we did to create this inequality, we kind of know what we need to do to undo it. And the second piece is something that you had said earlier, which is that this is really not that long ago. Most people's parents or grandparents kind of lived while it, as you said, kind of was perfectly legal to explicitly discriminate based on race. And a question that I ask my students every year in my racial inequality class when we're kind of talking about these issues is, let's say you have two people, one has $1 in their hand and the other one does not. Who's more likely to have $1 in their hand tomorrow, right? It's a very simple exercise that kind of illustrates the fact that, unless you give that second person $1, they're not going to have an equal likelihood of having $1 the next day. And you can think about that exercise cumulatively over the course of years and over the course of generations, that just gets worse and worse when that dollar gets turned into buying a home or paying for college or to start a business or to pay for an emergency. That the kind of course of time only serves to make these inequalities worse.
Yep. Well, we got our hands full.
Yes.
So,
yeah.
Well, thanks a lot for joining me on Mostly Economics, and maybe we'll be able to come back in a couple of years and say how things are better. We'll see.
Yeah. We'll see. Yeah.
All right.
Thank you for the invitation. This has been a great conversation.
Yeah, I enjoyed it. Thanks.
Yep.
If you like what you just saw, please help us out by liking us and subscribing. Thank you.